Uber, the biggest ride-sharing platform on the planet, 200 million active users, 13 billion rides every year, yet the stock is trading at the same level that it was 2 years ago. Will it finally pop in 26, or is it about to get crashed by Waymo and Robotaxi? Is it an opportunity we don't want to miss around $80, or is it a hard pass? My name is Adri, I've been investing for almost 20 years. In this video I'm gonna answer those questions, but since Uber is not part of my portfolio, today I've invited a special guest. He has a $17,000 position in Uber and it makes up 18% of his portfolio. Aria Radnia, welcome to Adriconomics.
My name is Aria from the Aria Radnia YouTube channel. And Adria, I'm happy you decided to get me on to talk a little bit about Uber because it's frankly one of my favorite businesses.
Hey Aria, thanks for being here. I really need your help evaluating Uber. You see, in Italy, my country, the Italian taxi mafia lobby blocked Uber, so I don't use their app and I don't know their services very well, but looking at the numbers, the fundamentals seems very interesting. Revenue is growing rapidly, monthly active users are up, trips are moving up and to the right, and most importantly, free cash flow has exploded while share-based compensation is finally going down. My valuation model with my assumption show the company isn't expensive, price to 5 years forward earning power as Uber right here around 16, fairly valued area. Aria, help me out here. What are your specific assumptions for revenue growth between now and 2030?
So in terms of revenue growth, there's a couple different ways that we could tackle this. Firstly, I do want to mention, of course, there is that sort of quote unquote AV risk that comes with the business. And that's really a curveball in terms of our projections into the future, especially if you believe that that's going to materially impact the business on a going forward basis. We do have a segment on AVs in general later in the video, but for the sake of these projections right now, we're just going to assume that AVs are not going to be a material risk to the business, which again, we'll cover in a second here, and that the business kind of generates revenue growth and so on at the regular cadence that it has had over the past little while. And so in order to do that, I am going to go over to Fiscal AI, and very quickly, we can just see that the total revenue growth for this business over the trailing 12 months has grown at about 18%. It seems that coming out of late 2023, early 2024, there was a bit of a dip in terms of the revenue growth, and then now we've kind of stabilized around that 18% figure. But of course, just because a business has had a certain revenue growth over the past, even in this case, a year, that doesn't mean that that's going to be the revenue growth on a going forward basis. And so for me personally, when it comes down to doing the projections for the business, I kind of have to look at two different levers. And these are the two levers that Uber generally has in order to continue its revenue growth. The first lever is audience growth, and they measure this in terms of monthly active users. So if we go under the segment and KPIs tab, and then we toggle on the monthly active platform consumers, emphasis on the platform, because if somebody has Uber Eats and they also have the regular Uber app, they just count as one person. And then additionally, we want to look at the growth of that. As you can see, they have close to 200 million monthly active users, and the growth on this has accelerated to 17%, but over the past roughly 2 years, it's been roughly in that mid-teens range. And so you can imagine for each incremental user that comes onto the platform, you can essentially think of that as a one-to-one in terms of trips growth. Except, what about the existing users that are now transacting at higher frequency? So there's kind of these two different levers that Uber can pull on. The first lever is increasing number of users, and the second lever is of the existing users, they get more and more rides or more Uber Eats. And so that second KPI is under monthly trips divided by monthly active users. You should essentially just think of this as frequency. And we can see that the growth on that has been, roughly in the low single digits, maybe 3 to 4% roughly. If we take the longer term CAGR since 2021 here, we can see that it has roughly grown at about 5% compound annual growth rate over the past roughly 4 or 5 years. And so Adri, to answer your question, when it comes down to revenue growth over the next roughly 5 years, the business is currently growing at 18, maybe 20%, which is a mixture of about 15% audience growth, 5% frequency growth. I think it's a very safe assumption to say that over the next 5 years, the business could probably average a 15% revenue CAGR. And that's largely off of the back of Uber just continuing to expand business as usual, going into new countries, increasing the penetration of their services relative to other competitors within those countries, and really capturing more and more of this white space, especially globally.
Very interesting. So we are actually quite aligned on growth. I was a bit more conservative with 14% CAGR, but very similar. And I think it's actually incredible that we arrive almost at the same conclusion completely independently. But now, to make this valuation work, we need to talk about optimized margins. What's your take on Uber margin potential? Do you see Uber margin expanding in the coming years?
Now, in terms of operating margins, things are not as clear as it is with revenue growth. Your guess is honestly as good as mine. But at the end of the day, we have a couple different things that we could look at to try to get a general idea into what operating margins might look like by the year 2030. Again, this is assuming that the AV investment cycle doesn't turn into this big thing where they have to lean in with their balance sheet. More on that later in the AV segment. As it stands currently, Uber has operating margins of roughly 9%. And as you can see, things have generally been expanding up and to the right over the past, really it looks like the past 5 years or so. And it seems like those operating margins have generally kind of stagnated roughly in that 9-10%-ish range. Now, me personally, I think that there's a very real possibility where operating margins expand to roughly that mid-teens range, call it 15% or so. Some important things to note with this is there's a general operating leverage that comes with the business. So this chart that I have here is from a couple quarters ago, but nonetheless, the point still stands. As you can see, by that point, over the trailing 3 years, the total employee count of Uber had grown by 2%. Meanwhile, the revenues had more than doubled. So this is what I mean when I say there's a general sort of operating leverage built into the business. And then in addition to that, you have this sort of similar to the Amazon case, and there's a good amount of similarities between the two businesses, but similar to the Amazon case, you have this mix of higher margin revenues coming in. So particularly with the Uber One membership, and then they've also introduced advertising. Advertising at the moment is a $1.5 billion revenue run rate business for them. It is growing at about 60% year over year. And coincidentally, the Uber One subscription or membership, which, you know, it's like 0 delivery free and so on and so forth, that is also growing at about 60% year on year. Now, granted, these are small revenue segments. $1.5 billion run rate on a $50 billion revenue business isn't much at the moment. But the point is that that's probably a 30, 40, 50% operating margin business growing ridiculously fast. And over the next 5 years, if we extrapolate, even if the growth of that slows down, that should result in significantly higher margin revenues coming into the mix and resulting in higher margins overall across the business. Again, similar to a case which you've seen with Amazon's advertising and Amazon's AWS. I think you guys are starting to get the idea. And if it's worth anything, Morningstar is projecting 14% operating margins by the end of 2028. So I think our prediction of 15% might even be a little bit conservative, again, considering the higher mix of margin revenues, the general operating leverage built into the business. I think we're in the clear with that one.
Yeah, okay, so here is where we have a difference. Your assumptions is much more positive than mine. I was forecasting for a little margin expansion, but 12% operating margin. An extra 3-4% would be huge. With your numbers, Uber valuation would move from my 16 to around 11, 12, and the stock would look like a total bargain today. I was looking at some others' YouTuber opinion yesterday, and clearly you are not the only one thinking Uber is cheap. Check it out.
I've rated Uber as the best stock to buy this year, and I own Uber stock in my own portfolio.
Are fewer people going to own cars in busy places and they're just going to use Ubers everywhere? You know, if that happens, this is a fantastic buy today. The stock could double over the next 5 to 10 years.
Around $80, the stock is clearly interesting for many investors, but my main problem with Uber is that I see at least 3 big risks. Let's go straight to the main one, autonomous driving. Waymo rides has more than doubled since last year, and I found this research showing that Uber and Lyft are losing market share to Waymo in San Francisco. If a robot can drive me around cheaper than a human, does Uber business model survive? Does it make sense? Aria, are you not afraid that in the coming years, Waymo and Tesla Robotaxi will completely destroy Uber?
Right. So in terms of AVs, I mean, of course, this is the talk of the town. This is the big looming risk over the business. This is what everybody needs to kind of figure out. And so ultimately, we could really spend a whole 30, 40 minutes just talking about AVs and the variety of different ways that the industry could play out. But ultimately, if you're looking at investing in Uber, we could summarize everything down to just one very simple question or one very simple fact. And based off that, you could make your decision on whether or not this is a company for you. And that is ultimately the question of utilization. What I mean by utilization is essentially if you have a world where, for example, let's take a Tesla, let's take a Waymo, whatever, if we say that they're independent of Uber, right? In the city of Toronto, that's where I'm from, let's say that they have 500 autonomous vehicles spread throughout the city of Toronto. Now, the issue with that is that the way the world works is the demand is not consistent throughout the 24 hours of the day across the 7 days of the week. What you have, this is based off real data that Uber has collected over the past 15 years, and I strongly suggest you pause the video and look at this chart for yourself. But as you can see, there's massive peaks and troughs in terms of demand depending on the hours of the day. So for example, during the hours of 8 to 9 a.m., during the rush hour, when people are trying to get to work, the demand for ride hailing goes up massively. It goes to close to 2 times the baseline. And then you could see that a little bit past midnight, obviously when people are going to sleep, the demand for ride hailing falls off a cliff. It goes to roughly 0.3 times baseline. So what that means is, if you have, for example, 1,000 cars throughout the city of Toronto, these are autonomous vehicles, during rush hour, the demand is 2,000 cars per hour, for example, right? Arbitrary numbers. And then a little bit after midnight, the demand for cars is 300 per hour. And so what you have there is at any given point, except for that perfect equilibrium when you're at 1,000 cars, you're either massively under monetized or you're massively over monetized. If you have 1,000 cars and there's only demand for 300 rides per hour, there's 700 cars sitting completely idle there. If there's demand for 2,000 of them and you only have 1,000 cars, you're under monetized. You could have had 2,000, but because you don't have enough cars, you're not making those revenues. And so the offer that Uber has to all of these different AV partners, regardless of whether you're a Tesla, a Waymo, whatever, if you're independent of the Uber network, is at any given point, you're either under or over monetized. And so if you come onto the Uber platform, eventually what Uber is going to do is they're going to have this sort of hybrid service whereby they kind of use AVs as a base layer. So, going back to the city of Toronto example, if 300 is like the minimum number of cars in that city, maybe they'll have roughly, 300, 400, whatever the case is. That serves as a base layer of cars within that region. And then, because again, they have this 15 years of historical data, this is meta heuristic data that you have to go and gather out manually. Yes, you could simulate it, but the cost of simulating that data is unbelievably expensive and just not worth the cost, all things considered. Because they have this meta heuristic data, they know. And if you've ever seen the app from a driver's perspective, you can see that there's like a 3 times multiplier, or like a 1.5 times multiplier. Hey, Aria, if you go to this neighborhood in Toronto, we're going to pay you a little bit extra because there's going to be an increase in demand based off of this meta heuristic data that they've collected. And so what Uber will do is they'll have that sort of base layer of autonomous vehicles servicing the minimum required number of rides per hour. And then you're able to kind of layer on human drivers on top of that to react to the fluctuations in demand depending on the hour of the day, or, in some cases there might be a concert. In some cases, there might be a certain road closure, right? Think of just like all the miscellaneous things like that. Uber has so much data in the 10,000 cities around the world that they can basically be able to plan around a certain highway closure, a certain road closure. They've dealt with so much unique cases like that. And frankly, these are just things that the average investor like you and I isn't even thinking about. But for an AV company to scale on their own, it would require multiple years of running this business and trying to just catch up to the data moat that Uber has, not to mention, of course, the utilization issue. And so in summary, Uber is a method for these AV companies to maximize revenue per car. If they go with Uber, they will almost always have 100% utilization and maximize revenue per car. If they try to do it by themselves or they try to do it independent of Uber, odds are that they're going to be making less revenue per car. And I don't think I need to tell you this, but I would assume most of these AV companies are perfectly happy taking a slightly lower gross margin in order to make more total profit in general.
I see your point and I agree. Uber's user base, network and data moat are incredible assets, but there is a period of transformation and Uber business model will have to change in the coming years, and this comes with a lot of uncertainty. Also, competition is getting crazy. Not only Waymo and Tesla, but now also Rivian just announced they are entering the Robotaxi market as well. Uber seems to be reacting to this. They are investing in Nuro and Lucid to develop their own autonomous fleet, but this would be a massive shift. They would be moving from a business that is asset light, basically they own nothing and they print money out of thin air, to a business that is asset heavy, they would own the cars. Do you think management is making the right decision?
This is another interesting topic for us to kind of talk about. But again, just for the sake of time, I'm not going to go too into the details with it. Uber themselves have pledged that they will be willing to lean in with their balance sheet, and particularly because they have an incredible free cash flow profile of roughly $9 billion of free cash flow. Granted, some of it is insurance reserves and some of it is stock-based compensation. Nonetheless, this is a very high cash flow generative business that is growing revenues north of 20%. They have the financial profile to be able to lean in with their balance sheet is kind of what I'm getting at. And so, for example, one of the clearest examples of this that we have is earlier in the year, they invested $400 million into the Lucid Neuro deal. And no, they don't own the cars outright, but they kind of helped out to get that jump started. And so that will be bringing on 20,000 cars onto the roads over the next 5 years for that Lucid Neuro partnership. And Dara himself has, been quoted on multiple occasions saying, like, with most of these businesses, whether it's AV related or not, most of these new products that they're trying to bring to market, whether it was the initial Uber product itself, Uber Eats, you have Reserve, you have the grocery business that they have now. They've launched roughly 10 to 15 different products over the entire lifespan. What they initially always do, and this is their playbook, and they've ran it so many different times, they invest heavily upfront at a loss, try to build the network effects and try to get mass adoption with consumers, and then eventually drive up take rates and improve the margins on those businesses. And so this is essentially what they're doing once again. They're putting in this big sunk cost initially to kind of get the AV ecosystem built out and get consumers to adopt these AVs. And then they said that although they are willing to lean in with their own balance sheet and kind of own these fleets initially, they believe that these things will get financials over time. So what that means is similar to how you have REITs today for owning like malls and hospitals and whatever the case is. They believe that there's going to be some form of a private equity or REITs that own specifically fleets of autonomous vehicles and kind of generate like a 5 to 6% yield, and investors can invest in those REITs for autonomous vehicles. And then again, there's a question of actually cleaning these cars and so on and so forth. Uber has partnered up with a variety of fleet operators. And so again, there's going to be a specific company and business that is going to be servicing that side of the equation as well.
I understand. In that light, it does make a lot of sense for Uber to have their own autonomous vehicle, at least as a trial. Last problem, and I really want your take on this one because it kind of scares me, regulation and legal troubles. Looks like Uber is fighting a war on 3 fronts. First, the worker classification issue. As we have seen in the Netherlands and in Belgium, courts ruling drivers are effectively Uber employee, meaning Uber has to pay social security. If other countries follows, margins might collapse. Second, there are 3,000 lawsuits regarding sexual assaults litigation connected to Uber, claiming Uber failed on safety and background checks. The process will start in January, but it might be expensive for Uber. Third, the protest. In one side, we have the taxi drivers in Barcelona protesting against Uber. On the other side, we have the drivers protesting against the company for higher pay and lack of social rights. Aria, are you not afraid that all these legal issues will drag the share price down next year?
Perhaps naively, I brush this off. The fact is that Uber is a highly localized business, so they operate in 70 countries across an estimated 10 to 15,000 cities. If a certain country or city requires, worker classification or requires minimum hourly earnings, whatever the case is, we actually saw this in New York City. They have a minimum hourly earnings. At the end of the day, and again, perhaps naive of me to say, but I think that plays to Uber's advantage. Increased regulation is good for the incumbents because it makes the barriers to entry for new entrants significantly higher. So if every single city, and this is the case in the world today, if every single city has its own tiny little nuances and tiny little laws, for example, I was recently in Cabo and the Ubers in Cabo are not able to come all the way to the front of the hotel pickup and drop off. So if you're Ubering from the airport to the hotel, they drop you off at the gate. You have to walk for like 3 minutes, right? Inconvenient, whatever. Point is, that's a very specific nuance just for that city and perhaps just for a certain region in that city. Again, depending on where you live, you might notice that there's certain areas that Ubers can go and cannot go within your local airport, for example. Here in Toronto, there's a dedicated lane specifically for Ubers and Lyfts to be able to pick you up and drop you off, right? So there's all these different nuances, again, across at least 10,000 cities. And ultimately, that plays to the advantage of the incumbent. Because for a new entrant, for example, a Tesla, a Waymo, they have to go out and get all these different legal nuances right for them to be able to operate their service within that city. It's a lot of red tape, this and that, whatever. Or you could just partner up with Uber. They've already got it all figured out. And boom, right away, go to market, instant monetization of your AV fleet, and you're off to the races, making revenues instead of having to deal with legal nonsense and red tape.
Aria, thanks for the insights. I know I sounded kind of bearish today. In reality, I'm not. But as a contrarian, it kind of comes natural to me to look for the negative when I'm talking with someone bullish. While researching, actually, I was very impressed with Uber. For example, their marketing campaign in so many different countries are really, really cool. Please give us your final take. Am I forgetting anything important?
All in all, I think there's no denying that the core business is simply brilliant, independent of the AV fears. The growth profile is absolutely incredible. The valuation is absurdly cheap. But the main question you need to ask as an investor is how comfortable you are with the AV research, with the AV situation. Me personally, based off hundreds of hours of research that I've done, I'm personally of the belief that Uber is currently responding very aggressively and shaping the industry right in front of our eyes. Ultimately, the value that Uber provides to the network as well is incredible. As I highlighted time and time again, there's that utilization question, which Uber outright solves. There's the regulatory piece across 10,000 cities. And so I think there's a lot more barriers to entry than people give Uber credit for. And ultimately, I believe we'll look back 5, 7, maybe 10 years down the line and look at a world where Uber is the demand aggregator for AVs. And they have built out this hybrid network of both human drivers and AV partners for their technology. And also there's a case of, Waymo and Tesla can operate independent of Uber, but also list on Uber to be able to maximize revenue per car. And so with that, I just wanted to thank Adri for having me on the channel. I'm sure he's going to link it in the description or something like that. If you're interested in sort of like deep dives and stuff like this, I do them very frequently. I did one on Adobe recently titled Why Adobe is Impossible to Disrupt. It's a 2-part series, and we kind of went through talking the AI risks of that business as well. I've gotten a lot of great reception on that, so feel free to go check that out. Thank you, Adri, for inviting me on the channel. Cheers, guys.
Thank you to help me out on this one. To sum it up, we agree the business is growing. I wouldn't call it absurdly cheap, but I agree Uber is not expensive and might be a buy today. Ultimately, it all comes down to risk, and that's a very personal assessment everybody should make on their own. I will keep thinking about it for a while longer. So write a comment and let us know your take on Uber. A massive thanks to Aria for joining us today and to you for watching until the end. Check out Aria's channel and his great bullish Adobe's video, or my more cautious approach in this video right here. See you next week. Peace out.